They want you to believe the rally is over. They want you to look at your phone this morning, see $72 flashing red on the screen, and feel that familiar pit in your stomach. They want you to think you missed it. They want you to think the bubble has finally popped. They are lying to you, and I have the proof. Right now, as I am recording this video on January 1st, 2026, there are two silver markets operating on planet Earth, and they have completely divorced from each other. In one market, the paper market, the COMEX futures price shows $72, down from $84 just days ago, a brutal 15% crash. The financial media is running victory laps. The shorts are celebrating. The algorithm traders are high-fiving. But in the other market, the physical market, something terrifying is happening. Silver is trading at $100 per ounce in China. Dealers in the United Arab Emirates are selling at $86 to $100. And in America, the shelves are empty, completely empty. Kilobars are sold out at every major dealer. AppMex just moved 20% of their entire inventory in less than 24 hours. SD Bullion is showing out of stock on product after product. JM Bullion cannot keep silver on the shelves. And the metal they do have, they are not selling it at $72. They are not selling it at $80. They are pricing it at premiums that bring the real cost to $90, $100, even $120 per ounce. Do you understand what this means? The number on your screen is a lie. It is a ghost price for a ghost market. It is a number generated by algorithms trading paper contracts in a casino that has run out of chips. In this four-part investigation, I'm going to expose the greatest divergence in precious metals history. I'm going to show you proof that dealers cannot and will not sell at the paper price. I am going to explain why the CME raised margin requirements 3 times in 1 week, a desperate move that screams panic. And I am going to prove to you that the crash to $72 is not a crash at all. It is a trap. The paper market is dying. The physical market is screaming. And you are watching the birth of a 2-tier silver system in real time. The ticker says $72. The real world says $120. Which one do you believe? Let me walk you through exactly what happened over the past week, because the sequence of events tells you everything you need to know about who is winning and who is losing. On December 28th, silver hit an all-time record high of $84 per ounce. The breakout was violent. The shorts were bleeding. The momentum looked unstoppable. Then, on December 29th, the CME Group, the entity that operates the COMEX futures exchange, dropped the first bomb. They raised margin requirements from $20,000 to $25,000 per contract. That is a 25% increase overnight. Let me explain what this does. When you trade silver futures, you do not pay the full value of the contract. You put down a deposit called margin. If you control 5,000 ounces of silver at $80 per ounce, that is $400,000 worth of metal. But you only need to post $25,000 in cash. This leverage is what allows speculators to make huge bets with relatively small amounts of capital. It is also the kill switch that the exchange controls. When the CME raises margins, every trader holding a position suddenly needs more cash. If they cannot wire the money overnight, the exchange liquidates their position automatically. It forces selling. It creates cascading liquidations. It crashes the price. This is exactly what happened. On December 29th, silver plunged from $84 to $73.72, the largest single-day drop in 4 years. The media screamed crash. The headlines declared the bubble had burst. But the CME was not finished. 2 days later, on December 31st, they raised margins again from $25,000 to $32,500. That is a 30% hike on top of the previous 25% hike. In the span of 1 week, they increased margin requirements by over 60%. 3 margin hikes in December. 3. This is not normal market management. This is warfare. And here's the part that should make you very, very angry. The margin hikes only affect the buyers. They only affect the people betting that silver will go up. The big banks, the commercial shorts, the entities betting against silver, they have credit lines. They have access to unlimited capital from the Federal Reserve's repo facilities. They do not get liquidated. The margin nuke is a targeted weapon designed to flush out the retail traders, the small speculators, the people who cannot wire $50 million at 2 a.m. It is a rigged game, and it is being played in broad daylight. But here's what they did not expect. The price dropped to $72 on the paper market. And then something unusual happened. The selling stopped. The floor held. The weak hands were flushed out, but the strong hands did not sell. Why? Because the strong hands are not trading paper. They are accumulating physical. And they know that $72 paper silver is the buying opportunity of a lifetime when physical silver is trading at $100 in Shanghai. Now, let me show you the proof, the evidence that the paper price and the physical price have completely diverged. I want you to go to your computer right now, open a new tab. Go to sdbullion.com, search for kilo silver bar. What do you see? sold out. Out of stock, unavailable. Now go to JM Bullion, same search, sold out. Now go to APMEX, same search, sold out. 3 of the largest precious metals dealers in North America. Combined, they move millions of ounces per year. And right now, on January 1st, 2026, they cannot sell you a kilo bar of silver. This is not normal. This has never happened at this scale. On December 28th, a Twitter account that tracks dealer inventory posted a remarkable observation. APMEX had a starting inventory valued at $6.15 million. Within 24 hours, that inventory dropped to $4.8 million. They sold $1.3 million worth of silver in a single day. And they are not restocking, because they cannot restock. The supply chain is broken. Now let me show you what is happening with the silver they do have available. Go back to those dealer websites. Look at the American Silver Eagles. Look at the Canadian Maples. Look at the generic rounds and bars that are still showing in stock. What is the price? At $72 spot, you would expect to pay maybe $75 to $80 for a Silver Eagle, accounting for a normal premium. But that is not what they are charging. Dealers are asking $90 to $100 for products that should cost $75. Some specialty products are priced at $110 to $120 per ounce. The premium, the difference between spot and the actual purchase price, has exploded. It is not 5% or 10% like normal times. It is 30%, 40%, 50% or more. This is the proof. The dealers are telling you, through their pricing, that $72 spot is fake. They will not sell you metal at that price because they cannot replace it at that price. They know that when they go to restock, they will be paying $90 or $100 per ounce from their suppliers, so they price accordingly. And if you do not like it, too bad. They would rather sit on the inventory than sell it at a loss. Let me take you overseas. Because what is happening in Asia makes the American situation look calm. On December 27th, physical silver on the Shanghai Gold Exchange hit $90 per ounce. While the COMEX was showing $77, Shanghai was showing $90, a $13 premium, the largest spread on record. By December 29th, reports emerged that silver in Shanghai had crossed $100 per ounce. Reddit users living in China posted that retail silver at local shops was selling for $100 or more. Not $72, not $80, $100 per ounce. Think about that for a moment. The COMEX says silver is $72. Shanghai says silver is $100. That is a 40% difference. In a normally functioning market, arbitrage would close this gap instantly. Traders would buy in New York at $72 and sell in Shanghai at $100, pocketing the $28 difference. But that arbitrage is not happening. Why? Because you cannot get the physical silver out of New York. The vaults are empty. The delivery mechanism is broken. The metal that is supposed to back those COMEX contracts either does not exist or is not available for delivery. When arbitrage breaks down, it is a sign that the market is fractured. The paper price and the physical price are no longer connected. They are operating in different universes. And it gets worse. The United Arab Emirates is showing similar dynamics. Dealers in Dubai are selling silver at $86 to $100 per ounce. Buyers are paying massive premiums just to secure physical metal. Meanwhile, Western dealers are refusing to sell at spot. Some have stopped taking orders entirely. The website goes dark. The phone goes to voicemail. The message says, due to extreme market conditions, we are not accepting new orders at this time. This is not a price crash. This is a supply collapse. The paper price can say anything it wants. It can say $72. It can say $50. It can say $20. None of it matters if you cannot actually buy silver at that price. And right now, on January 1st, 2026, you cannot buy silver at $72. That price does not exist in the physical world. It only exists on a computer screen in Chicago, generated by algorithms trading paper promises. Part 2, the margin massacre. If you watched Part 1, you now understand the crime scene. The paper price says $72. The physical price says $100 or more. Dealers are sold out. Premiums are exploding. The market is fractured. But you need to understand how we got here. You need to understand the weapon that was used to create this divergence. Because once you see the mechanism, you will never trust the paper price again. In Part 2, I am going to dissect the margin massacre. I am going to show you why the CME raised margins 3 times in 1 week. I'm going to explain the mathematics of forced liquidation. And I am going to prove to you that the crash was not a natural market event. It was an orchestrated bailout of the short sellers. The banks were losing billions, so they changed the rules, and they thought you would not notice. Let me start with the timeline, because the sequence is damning. December 26th, silver is trading at $79 per ounce. The momentum is bullish. The shorts are bleeding. Bank of America, which holds one of the largest short positions in silver history, is facing catastrophic losses on paper. December 26th, evening, the CME Group issues a notice. Effective December 29th, margin requirements for silver futures will increase from approximately $20,000 to $25,000 per contract. A 25% hike. December 29th. The margin hike takes effect. Traders who cannot meet the new requirements are liquidated. Silver crashes from $84 to $73.72 in a single session. The largest single-day drop since February 2021, December 31st. The CME issues another notice. Effective January 1st, margin requirements will increase again from $25,000 to $32,500. A 30% additional hike, January 1st. The second margin hike takes effect. Silver trades around $72. 3 margin hikes in 1 week. The cumulative increase is over 60%. This is not normal risk management. This is intervention. Let me explain why this matters. The stated purpose of margin requirements is to ensure that traders can cover their losses. If you bet wrong, the exchange wants to make sure you have enough cash to pay up. Higher margins theoretically reduce the risk of default. But here's the problem. The CME did not raise margins gradually over months, as you would expect for normal risk management. They did it in 3 massive spikes over 1 week, specifically timed to coincide with the highest prices and the most bullish momentum. The timing is not random, it is targeted. Think about who benefits from this timing. When you raise margins during a rally, you force the long positions to liquidate. The people betting that silver will go up suddenly need 60% more cash. If they cannot provide it, they sell. The selling creates downward pressure. The price drops. Who is on the other side of this trade? Who benefits when the price drops? The shorts, the banks, the entities betting against silver. The margin hike is designed to rescue the short sellers by forcing the longs to liquidate. It is a bailout disguised as risk management. Now let me show you how this works mathematically. Because the numbers do not lie. Imagine you are a small hedge fund. You believe silver is going to $100. You buy 100 contracts at $80 per ounce. Each contract controls 5,000 ounces. You control 500,000 ounces of silver, worth $40 million. Under the old margin requirements, you needed roughly $20,000 per contract. That is $2 million in cash to control your position. Overnight, the CME raises margin to $25,000 per contract. Now you need $2.5 million. You have to wire $500,000 by tomorrow morning, or the exchange liquidates your position. You scramble. You find the money. You survive. Then, 2 days later, the CME raises margin again to $32,500 per contract. Now you need $3.25 million. Another $750,000 due immediately. Can you wire $750,000 at 2 a.m. on New Year's Eve? Probably not. Your broker liquidates your position at the worst possible price. This is the margin massacre. It is not about risk management. It is about forcing small traders to sell so the big banks can cover their shorts at lower prices. And the evidence is in the timing. If the CME was genuinely concerned about risk, why did they wait until silver hit all-time highs to raise margins? Why not raise them gradually over the preceding months as the price climbed from $30 to $80? The answer is obvious. They did not want to slow the rally when it was convenient for the banks to accumulate short positions. They only intervened when those short positions were about to blow up. This is the dirty secret of the futures market. The exchange is not a neutral arbiter. It is a tool used by the largest players to manage their exposure at the expense of smaller traders. Let me show you the Seeking Alpha article that exposes this explicitly. A piece published today, January 1st, titled COMEX Liquidation, Why CME's $25,000 Margin Hike is Bailout Not Crash, lays out the case. The CME's decision to hike silver margins 3 times in December, culminating in today's extraordinary $25,000 plus per contract requirement, is not a response to market risk. It is a response to the imminent failure of the paper market to deliver physical silver. The article continues, silver is experiencing a forced liquidation event orchestrated by the CME Group. Spot prices have been hammered nearly 15% this week to around $72 per ounce. And then the key insight, physical decoupling. The COMEX paper market will struggle to source physical silver for delivery, while the Shanghai Futures Exchange continues to show massive premiums. This is not conspiracy theory. This is financial analysis from a mainstream investment platform stating openly that the margin hikes are designed to prevent delivery failures. They're crashing the paper price because they cannot deliver the physical metal. The banks are not managing risk, they are covering their tracks. Now, let me connect this to what happened in 1980 and 2011, because the playbook is identical. In January 1980, the Hunt brothers had accumulated a massive long position in silver. The price had risen from $6 to nearly $50. The shorts were facing catastrophic losses. What did the COMEX do? They implemented liquidation-only trading. They made it illegal to buy new contracts. You could only sell. They raised margin requirements repeatedly. They changed the rules to force the hunts to liquidate. Silver crashed from $50 to $10. The hunts were bankrupted. The shorts were saved. In May 2011, silver had risen to $49. The momentum was unstoppable. Then the CME raised margins 5 times in 9 days. 5 times. Each hike forced more liquidations. Silver crashed to $33 in weeks. The pattern is the same every time. When silver threatens to break the banks change the rules. They use margin hikes as a weapon to force liquidations. They crash the paper price to levels where they can cover their shorts. And every time, the mainstream media calls it a bubble bursting or a natural correction. They never mention the margin manipulation. They never explain who benefits. But this time is different. In 1980 and 2011, the paper price crash corresponded to a physical price crash. When the COMEX dropped, the dealers dropped their prices too. The market was still functioning as one unit. In 2025 and 2026, the paper price crashed, but the physical price held. Dealers are not lowering prices. They are raising premiums. The shelves are empty. Shanghai is paying $100, while COMEX says $72. This is the first time in history that the margin massacre failed to crash the physical market. The paper market is dying. The physical market has declared independence, and the gap between them is proof that the manipulation has reached its limit. Part 3. The proof of the divergence. If you have watched parts 1 and 2, you understand the two realities now operating in the silver market. Paper silver says $72. Physical silver says $100 or more. The CME crashed the futures price through margin manipulation. But the dealers are not selling at that price. In part 3, I'm going to give you the hard proof. Screenshots, sources, numbers. I'm going to walk you through dealer after dealer, showing you the actual prices they are charging. And I'm going to show you the Shanghai premium, the China panic buying, and the reports from people on the ground who are seeing physical silver trade at levels the paper market says are impossible. This is the evidence. This is what they do not want you to see. Let me start with the dealer inventory reports. On December 29th, a post went viral on social media. A user tracking AppMex inventory reported that the company had sold over $1.3 million worth of silver in a single 24-hour period. Their starting inventory of $6.15 million dropped to $4.8 million overnight. This is extraordinary volume. AppMex is one of the largest precious metals dealers in North America. They have relationships with mints and refineries around the world. They can usually source metal within days, but they are not restocking. The inventory continues to decline, and the products they do have are priced at massive premiums. Another Twitter post from the same day reported, Kilo silver bars sold out at all major bullion dealers. SD Bullion, JM Bullion, AppMex, silver kilo bar inventory wiped out by historic demand. Kilo bars are the workhorse of the silver investment market. They are liquid. They are recognizable. They are what serious stackers buy. And they are gone at every major dealer at the same time. This is not localized demand. This is nationwide panic buying that has overwhelmed the supply chain. Now let me show you the premiums. I went to JM Bullion's website this morning. The spot price displayed on their chart was $72.29 per ounce. That is the paper price they are showing. But when you click on actual products, the story changes. Dealers are asking $90 to $100 for products that should cost $75 based on spot. Some specialty products are priced at $110 to $120 per ounce. The premium, the difference between spot and the actual purchase price, has exploded. It is not 5% or 10% like normal times. It is 30%, 40%, 50% or more. The dealers are telling you through their pricing that $72 spot is fake. They will not sell you metal at that price because they cannot replace it at that price. They know that when they go to restock, they will be paying $90 or $100 per ounce from their suppliers, so they price accordingly. And if you do not like it, too bad. They would rather sit on the inventory than sell it at a loss. Now, let me take you to Shanghai. On December 27th, the Shanghai Gold Exchange showed silver trading at approximately $83 to $90 per ounce in USD terms. The COMEX was showing around $77 at the same time. That was already a $6 to $13 premium. By December 29th, after the margin massacre, COMEX had crashed to $72. But Shanghai did not follow. Reports emerged of silver trading at $90, then $100 on the Shanghai Exchange and in physical dealer shops across China. A Reddit user posted on December 29th. I live in China. Physical silver is now at about $100 on all major platforms. Another user asked, how is the Shanghai price $83.44, but the US price $71.10? The answer is simple. The US price is not real. It is a paper price for a paper market. The Shanghai price is for actual physical metal that Chinese buyers are desperate to secure before the export ban fully takes effect. The Yahoo Finance article from December 28th confirms this. Silver price surges to $100 in China as retailers seek new ways to exposure. Several posts and market reports suggest that China and the UAE are aggressively upselling silver amid a supply shock, with retail prices reportedly ranging between $86 and $100 per ounce at local shops. This is not speculation, this is reported fact. Physical silver in China is trading at $100, while the COMEX says $72, a 40% divergence. Let me explain why the arbitrage is not closing this gap. In a normal market, if silver is $72 in New York and $100 in Shanghai, traders would buy in New York and sell in Shanghai. The buying pressure in New York would raise the price there. The selling pressure in Shanghai would lower the price there. The gap would close within hours. But that is not happening. The gap is persistent. It has lasted for days. Why? Because you cannot get the physical silver out of New York. The COMEX vaults have been draining for years. In December alone, over 60% of the registered silver inventory, approximately 47.6 million ounces, was removed. The vaults are at multi-decade lows. When you buy a COMEX contract, you're buying a promise. The promise says that if you demand delivery, someone will give you 5,000 ounces of silver. But what happens if the silver is not there? They settle in cash. They pay you the paper price, not the physical price. They give you $72 per ounce when the metal is worth $100, or they declare force majeure. They say an extraordinary event has prevented delivery. Sorry, no silver for you. The arbitrage does not work because the arbitrageurs know they cannot actually take delivery. The COMEX silver is a fiction. You might be able to get lucky and extract some metal, but at scale, the metal is not there. So the Shanghai price reflects physical reality, and the COMEX price reflects paper fantasy. And the gap between them is the measure of how broken the system has become. Now, let me show you the first delivery failure of 2026. A video posted earlier today, January 1st, 2026, is titled, Default Declared. The first delivery of 2026 just failed, $12 premium. The description reads, the COMEX has not even opened yet, and we already have the first casualty of 2026. A major private transaction between an industrial buyer failed because the seller could not source the physical metal. The industrial buyer wanted delivery. They had a contract. They had paid the paper price. And when the delivery date arrived, there was no silver. The settlement? They had to pay a $12 per ounce premium to find alternative supply. The paper price of $72 became a physical price of $84. And that was for an industrial buyer with leverage and relationships. Retail buyers would pay even more. This is what default looks like in slow motion. The COMEX does not announce failures. They quietly settle contracts in cash. They quietly negotiate premiums. They quietly pretend the system is functioning. But the premiums tell the truth. If the system was functioning, premiums would be minimal. If you could actually get silver at $72, nobody would pay $84. The premium exists because the metal does not exist at the paper price. Every premium is a confession. It is the market admitting that the paper price is a lie. Part 4. The road ahead. If you have followed this investigation, you now see the truth clearly. The paper price says $72. The physical price says $100 or more. The CME crashed the futures market through coordinated margin hikes. The dealers have empty shelves and massive premiums. Shanghai is trading at a 40% premium to New York. And the first delivery failure of 2026 already happened before the market even opened. In part 4, I'm going to explain what comes next. I'm going to show you the stages of the decoupling. I'm going to give you the price targets for physical silver, and I am going to explain why the crash to $72 is actually the greatest buying opportunity you will ever see. The paper market is dying. A new market is being born, and you have a front row seat. Let me start with the stages of decoupling, because this does not happen overnight. It happens in phases. Stage 1, premium expansion. We are in this stage right now. The paper price exists, but it becomes increasingly irrelevant. Dealers add premiums that bring the effective price to physical reality. A $72 spot price becomes a $90 or $100 purchase price. The premium is the gap between fiction and reality. During this stage, most people still reference the paper price. The media reports the COMEX number, the charts show the futures price. But the actual transaction price, what you pay to acquire metal, is much higher. Stage 2, inventory depletion. The premiums attract sellers. Some stackers who bought at $20 or $30 decide to take profits at $90 effective price. This metal flows to the dealers, but the new demand overwhelms the selling. The shelves empty faster than they refill. During this stage, you start seeing sold-out notices that last for days or weeks instead of hours. Products that were always available become scarce. Dealers start implementing purchase limits. Maximum 10 ounces per customer. We are entering stage 2 now. Kilo bars are sold out. Certain products are unavailable. And it is only January 1st. Stage 3. Dealer withdrawal. When dealers cannot source metal at any price, they stop selling. They put up notices saying they are not accepting orders. They stop answering phones. The websites go dark. Some dealers will try to stay open by massively increasing premiums. You might see a $72 spot with a $50 premium, making the effective price $122. At that point, the paper price is completely meaningless. During stage 3, the secondary market becomes dominant. People trade with each other directly. Local coin shops become the only source, and prices are whatever buyer and seller negotiate. Stage 4, paper market collapse. When enough people realize the paper price is fake, they stop trading it. Volume dries up. The COMEX becomes a zombie market, trading contracts that represent silver nobody can actually obtain. At this point, price discovery shifts entirely to physical markets. The Shanghai price becomes the reference. The dealer price becomes the reference. The COMEX price becomes a historical curiosity. We are not at stage 4 yet, but the speed of this crisis suggests we could get there faster than anyone expects. Now, let me give you the price targets. For paper silver, the target is irrelevant. It could go to $60. It could go to $50. The banks can crash it as low as they want by raising margins and forcing liquidations. But who cares? You cannot buy silver at that price anyway. For physical silver, here are my targets based on the fundamentals. Near term, January to March 2026, $100 to $120 per ounce. This is where dealers are already pricing effectively. The Shanghai premium, the UAE prices, the premium at APMEX and SD Bullion all point to physical silver in this range. As China's export controls take full effect, the supply chain gets tighter. Industrial buyers panic, retail demand stays elevated. The effective price stabilizes in the $100 to $120 range. Midterm, Q2 to Q3 2026, $150 to $180 per ounce. As the deficit accumulates, as the vaults continue to drain, as industrial users start facing production shutdowns due to silver shortages, the panic intensifies. At $150 silver, a solar panel costs an extra $50. An iPhone costs an extra $20. The green energy transition stalls. Governments start intervening, stockpiling, invoking emergency powers. Long-term Q4 2026 and beyond, $200 plus. If the structural deficit continues, if China refuses to export, if mining production cannot increase, there is no ceiling. Silver becomes unobtainium. The price becomes whatever desperate buyers are willing to pay. Robert Kiyosaki, the Rich Dad, Poor Dad author, has publicly predicted silver reaching $200 in 2026. Given what I have shown you today, that prediction does not seem extreme. It seems conservative. Now let me tell you what to do. If you are holding physical silver, do nothing. You own the asset that the world desperately needs. You own the metal that dealers cannot source. You own the insurance policy against the collapse of the paper financial system. Do not sell because the paper price dropped to $72. That price is fake. The real price is $100 or more. If you sell at the paper price, you're giving away your silver at a massive discount. Do not trade your physical metal for paper promises. Do not swap your coins for an ETF. Do not exchange your bars for futures contracts. Paper is worthless when the system fails. If you are looking to buy, act immediately. Every day you wait, the shelves get emptier. Every day you wait, the premiums get higher. On a crash. To $72 is your last chance to buy at effective prices below $120. Go to your local coin shop. Call them first. Ask what they have in stock. Ask what their premium is. Then buy what they have. Do not be picky about designs or dates. An ounce is an ounce. If the local shop is sold out, try the online dealers. Check JM Bullion. Check SD Bullion. Check APMEX. Look for products that say in stock. And True in ships within 1 to 3 business days. Ignore the pre-order items. You want metal you can receive. Buy weight, not collectability. Generic rounds, bars. Whatever is available at the lowest premium per ounce. The time for hunting rare coins is over. This is survival accumulation. Let me leave you with the final thought. The paper price of silver is $72. The media will report this number, the charts will show this number, the algorithms will trade this number, but the paper price is a ghost. It is a memory of a market that used to exist. It is the final gasp of a manipulation scheme that has run out of metal. The real price of silver is what you can actually buy it for. And right now, that price is $100, $110, $120 or more. The divergence between paper and physical is the crack in the dam. The water is pouring through. The flood is coming. On one side of the flood, there are people holding paper promises, ETF shares, futures contracts, digits on a screen. On the other side, there are people holding physical metal, coins, bars, Real money that cannot be printed, diluted, or defaulted on. When the dam breaks, which side do you want to be on? The crash to $72 is not a crash. It is a gift. It is the system giving you one last chance to exchange worthless paper for real metal at an artificially suppressed price. Take the gift, buy the dip, and hold on. The paper market is dying. The physical market is being born. And the holders of real silver are about to become the wealthiest people in the world. $72 on the screen, $120 at the dealer. Which one is real? You already know the answer. Stay stacked, stay strong, and I will see you on the other side. Subscribe.